Hey everybody, thanks for joining us tonight. We're going to go on a webinar on diving deep into self-directed retirement accounts, and we're very honored and privileged to have Clint Coons join us from Anderson Advisors. Clint, how you doing?
I'm doing well, Ryan. Thanks for having me on.
Yeah, you're welcome. My name is Ryan Gibson. I'm with Spartan Investment Group, and I am the CIO at Spartan. And Clint is an attorney with Anderson Advisors and the founder too, right? Or one of the founders?
I am. Yep.
Awesome. That's great. Tell us a little bit about your background.
Yeah, so I am an attorney, but I'm also an active real estate investor. Often refer to myself as, or getting started in real estate when I was young. I grew up in a real estate investing family, and so that kind of gave me the bug for it. And when I was in college, I was a framer for a number of years. And just about as going through that experience, I realized that's not what I want to do long term, given the fact I live in Washington State where it rains all the time. So it sucks being outside as a framer when it's pouring down rain, which it does about 8 months out of the year. So I decided to go to law school. And when I got out of law school, I started Anderson Business Advisors with my partner, Toby Mathis. And our goal was really to help people protect their assets, especially real estate investors, because so many real estate investors, they don't understand that investing is more than just about asset protection or tax planning. It's really about building a business. And so you have to understand this three-legged stool concept, that you have the asset protection leg, you have the tax planning leg, and you have the business planning leg. And all three really need to work together. And that's what we've done at Anderson. We've shown people that, if you're investing with retirement accounts, if you're investing with money that you have, that you've accumulated in your savings, or if you have existing real estate, how to put all this stuff together in such a way that it's going to be protected, you're going to minimize taxes, and also, look good to lenders if you're looking to borrow money. So it's with that investor mindset that's helped me grow my portfolio to over 100 properties in 11 different states across the country. And it's really helped our clients expand their business as well.
Great. Yeah. Thanks, Clint. That really makes, especially the part about making yourself still be lendable to a bank. That's, I think, kind of the key thing, because you can wall up all that asset protection, but then not be lendable to a bank. So I can really appreciate that as a business owner. Yeah. So we're going to go ahead and just get the disclaimers out of the way. We're not offering advice, so definitely seek your outside counsel. And this is just a general overview, so seek your own advice. Information contained within is subject to change, and perform your own due diligence. So with that out of the way, I just wanted to talk a little bit about our webinars and where they're ending up. We're actually, Spartan Investment Group has a YouTube channel. If you wouldn't mind, subscribe to our YouTube channel. We've got a great webinar on operating agreements within a syndication. We had Mauricio Ruled in previous webinars this past quarter, and we talked about private placement memorandums, and we have a couple of webinars coming up, understanding capital accounts, and tonight we're talking about self-directed retirement accounts. So you can see where the little YouTube logo is. That's the webinars that we've had posted. We're also going to do complete due diligence on a sponsor, so an operator like Spartan, and how a K-1 impacts your tax return in a real estate syndication. So Clint had talked a little bit about how his team is kind of giving you that three-step approach, the legal, the asset protection, the tax planning, before you dive into real estate. And, I think when you start getting into the self-directed world, Clint will kind of talk about this a bit. You really have got to build your legal team and your financial and tax planning team before you especially start buying assets and start doing things within your retirement account, so you really understand the rules and you don't make a prohibited transaction. And I'm sure, Clint, you can kind of talk a little bit about the pitfalls of that if you do make a bad decision.
Oh, absolutely.
Yeah, and we're actually going to go through a case study tonight that talks about what happens when you make a mistake and how you can turn your retirement account into a taxable event and actually destroy the retirement account in general. So as everybody knows, there's tons of benefits of having a self-directed IRA. Normally, you've got the stocks, bonds, mutual funds you can invest in, but when you get a self-directed retirement account, it truly becomes self-directed in the sense that you can buy non-traditional assets, checkbook control, protection from creditors, control of your own investments. and you could invest in real estate, which is why I think a lot of people are on the webinar currently. But Clint, talk us about some of the constraints and the prohibitions of the account.
Yeah, you see, a lot of this really stems from the fact that most individual investors who use retirement accounts, in my opinion, they're just not getting the correct information many times, because there are so many people out there that offer self-directed IRAs today. I mean, you just do a Google search and you'll go through page after page of self-directed IRA companies. And what I have found is many people do not understand that those self-directed IRA companies, probably 90% of them, they're not custodians. They're what I call third-party administrators. It means they're a middleman, that they're enticing you to come and open up an account with them, and you roll your money over, and it really doesn't rest with them. It rests with a third party who is an actual IRA custodian. And so what has occurred in my experience in over 20 years of working with people on their retirement accounts to make investments into syndications and real estate, it's these middlemen that are providing information to real estate investors have really got them into some trouble, because they don't give them the proper information, the accurate information, because they don't know the rules themselves. And people who have IRAs, I mean, the thing is if you screw it up and you engage in a prohibitive transaction, for instance, you touch the money the wrong way, or you provide a service to your IRA, it's one and done. If it's audited and you're caught, then your IRA is burned at that point in time. And not only are you going to be subject to early withdrawal penalties, you're going to get hit with a penalty tax on the transaction itself and ordinary income tax. And in many cases, what you find is somebody will lose, close to 70% of their retirement assets just from something as simple as picking up a paintbrush and painting a house that's held inside of their IRA. So these rules are very important if you have retirement assets, because you don't want to risk everything and potentially lose it. And so what we have here on this slide here, we talk about unrelated business taxable income, or is referred to as UBIT. I mean, that's where your IRA engages in an active trader business, or you're investing into an LLC that is engaged in an active trader business. This can produce taxable income. As I talked about the prohibited transactions, that's something that the IRS showed a lot of interest in a few years ago. In fact, they showed so much interest in it, they went ahead and modified the annual reporting form that your IRA custodian or third-party administrator submits to the IRS on an annual basis. Most people aren't aware that when you open up an IRA, that there's a form, it's Form 5498, that your custodian will fill out and turn into the IRS. Sometimes they ask you for the information. And what the service did, Treasury, in 2014, they changed it to specifically target real estate investors, people who invest in real estate directly or indirectly through a limited liability company, through a trust, through a corporation, any private notes that their IRA may hold. And the reason they made this change, it was born out of the Senate Finance Committee, where they looked at it and they thought that real estate investors or investors who use these self-directed accounts were not paying their fair share of taxes, and that IRAs are engaging in prohibited transactions. And so now you have this system where whatever you're doing inside of your IRA that is outside the normal, invest in the stock market, it's being reported to the service. And so that then increases the risk of audits that come down, and the IRAs are then scrutinized. So that's been an issue. The disqualified party issue is something that why they wanted to amend 5498, because investors would take their IRA and let's say they were developing a piece of property and they saw an adjoining piece of property right next door, and they thought, well, it'd be great if I could secure that myself to keep someone from building next to me. So they take the funds from their IRA to buy it, and they buy this raw land in the name of their IRA. All right, you'd say, hey, investing in raw land, not a problem. But the issue arises that by buying that raw land, it benefited your development that is adjoining it. And so that one purchase disqualifies your IRA. And that's actually a court case where the investor or the developer, the person who was doing this real estate development, actually filed for bankruptcy, and he lost his IRA in bankruptcy because they found that that purchase of that land added value to his other development, and therefore his IRA was disqualified. So not only did he lose it in bankruptcy, he also had to pay a bunch of taxes on it. And so the disqualified party is someone, if it's you're a disqualified party to your IRA, your spouse is a disqualified party, your children are disqualified parties, anybody in your family tree, if you're just looking straight up and down, parents, grandparents, children, grandchildren are all disqualified parties, or even businesses that you own. Now, when we talk about disqualified parties, we're going to share with you an example of how you can partner with your IRA. And people will say, well, Clint, if I'm doing that, isn't that a disqualifying transaction? Well, this is where it gets technical. And going back to what I mentioned earlier about working with these third-party administrators, people who really don't understand the rules, they've gotten a lot of people into trouble in using their IRAs by not getting the proper advice and making investments that are with the disqualified individual, or it's considered to be a prohibited transaction. And so there's ways around it if you know how to set it up the appropriate way. And then we talked about taxes that are applicable here. Not only do you have UBIT that can come in if your IRA is considered to engage in a taxable business or invest into a business, you also have the situations with debt financing. And this is what shocks most real estate investors I work with that are in the space of using their IRAs, is that any debt can create taxable income. We got a great slide on that will explain it. And if you are, then you should be filing Form 990T, and a lot of people are missing that on an annual basis. And then it comes down to, performing your own due diligence and making sure you're getting the right information, because a lot of IRA custodians, the way they've been protecting themselves, because there have been a number of court cases in the last couple of years where people were audited and the IRS hammered them and they disqualified their IRAs. And the investors would come back and say, well, I was told by my third-party administrator that I could engage in this particular transaction. But the third-party administrator would defend and say, well, you can't blame us because we sent them out a letter of direction that they signed, and in that letter of direction, they acknowledged we did not counsel them on this investment they were making. We gave them no advice. We told them to seek their own independent legal counsel or tax advice as of the nature of the transaction. And in fact, in one of these cases that dealt with Entrust, the court actually took notice of the fact. They said there seems to be a disturbing trend here, that there are a lot of individuals complaining about the same thing, that their IRA was disqualified because they took action based upon the advice they received, and the defendant, being Entrust, keeps defending based upon these letters of direction. It's kind of like where there's smoke, there's fire. So that's been an issue. And so if you're going to invest with your IRA, make sure you're getting your due diligence, make sure you're working with people who truly understand the nature of the investment you're making, so you're not opening yourself up. Because with IRAs, as I stated, it's not something that you have forgiveness with. It's one transaction, your IRA's done. And then that really leads into the last point here, that your custodian, your administrator, is not your advisor. And you should be really careful if you're asking them for advice. And many of them shouldn't be even giving this advice, because in my experience, a lot of these companies that are out there that offer this type of service, you're not talking to an attorney, you're not talking to a CPA. Many times it's a salesman, and they're setting up the IRAs, they're receiving compensation for it. And so they want to keep their client happy, and the advice that they provide might be a little fast and loose. So it's always good to make sure that you're getting the advice from a professional advisor who understands what the types of investments you're looking to make and truly understands IRAs. I mean, I've been working in this particular area with real estate investors for 20 years, and it just amazes me how many people have taken the advice of individuals and really set themselves up for risk. And if that's the case, what I often tell people, if you feel like you're in that category, we're going to give you a solution at the end, what you could do, or quite possibly you just take your existing IRA if you want to stay that route and shut it down and roll everything to a new one and just take that infected one and kill it and make it go away. Or if you're going to engage in riskier transactions, set up multiple IRAs and take your higher risk transaction and run it through an IRA just with enough investments there for that one transaction. That way you don't risk infecting your other IRA assets if that goes bad on you. So there's a lot of things we have here. We're going to hit on a few of these points with some great examples. But it's something, if you have IRAs, you need to know the rules. You need to be aware of what you should or should not do, because the tax code is just not forgiving when it comes to mistakes that are made with IRAs.
No, that's a great point. And I think that's why we're having these webinars and having you on is, to help our investors come up with a strategy to make sure that they're not going to be surprised when the property sells, or worse, with making a bad decision with their retirement account. So all very good points. Um, so just kind of going through the investment options, we're going to just spend like just a second on this slide. So these are all the things that you can do with your SDIRA. You can buy and hold real estate, flip real estate, invest in private placements, which is what Spartan Investment Group does. Buy and sell tax liens and deeds, buy and sell private notes, hard money lending, private equity, stocks, bonds, mutual funds. A great way is just, you can, if you still want to invest in the stock market, you can connect custodial account or a stock brokerage account to the account. So let's get into this case study. So I'm going to just kind of run this through. So we're talking about Corey tonight, and he uses $200,000 of his $500,000 to invest in his IRA to purchase a house near his college his daughter is attending. Corey leases the house to several students and allows his daughter to live in the house rent-free, provided she collects the rent and deals with the other tenants. Did Corey commit a prohibited transaction?
Of course, the answer is yes. And this is actually a client case right here, where an individual had bought this property while his daughter was going to school, and thought he would, like, all right, I'll buy a property, she'll live in there, manage it, and rent it out, and it'll pay for itself and make a little money off it as well. Well, the problem was he made the investment with his IRA to purchase this asset. And by moving his daughter into the house, allowing her to live there, what has occurred is now the IRA is engaged in a prohibited transaction. And so it disqualifies the IRA. And so if we go to the next slide, you can see that what happens when an IRA is disqualified. So the day she moves in, that's a disqualifying transaction. So what happened to this individual, the entire IRA, not just the $200,000, the entire IRA, the $500,000 is taxable to Corey, and he's subject to a 10% early withdrawal tax, a 15% prohibited transaction tax, and ordinary income tax of 37%. So the net result is his IRA had about a $320,000 tax bill, which, as you can see, is almost 70% of that IRA now was lost because he put his daughter into the property. And this is where people get into trouble with IRAs, is they don't understand these rules, the prohibited transaction rules, and they can easily make this mistake. Now, if you did something like this and you came to me, the first thing I would tell you to do is, A, get your daughter out, and then B, this would be the prime example where we would shut that IRA down and roll the house and all the other assets out into a new IRA and then kill off the infected one. Or at a minimum, the way this transaction could have been completed is, if you only need 200 of the 500 to make the investment in the property, and you want to use the IRA to do it, or self-directed IRAs, then roll 200,000 into its own IRA, and then use that 200,000 to buy the house. Because one thing that's not addressed in this slide, which is equally important, is that when you invest directly into real estate with an IRA, you're buying a dangerous asset. It's a house. And people operate under this presumption or this false notion that IRAs are protected from creditors. And the fact of the matter is that that's not true. IRAs are protected from the owner's creditors in about 42 states. There's a handful of states that do not protect an IRA from an individual's personal creditors. But what we're focusing on here is a creditor of the IRA itself. That is, if you have rental property that you hold directly in your IRA and somebody's injured, they can sue the IRA and they can go after whatever's held inside of it. More importantly, they can look through the IRA, because the IRA is not like an LLC or an irrevocable trust. So the owners of the IRA could also be held liable for the problems that are associated with the IRA asset, which could be real estate. Let's say Carly or his daughter, Corey's daughter, had a party and someone falls down the stairs and they're now a paraplegic. Well, you can bet your IRA is going to be sued, and you're probably going to be sued as well as the IRA owner. So at a bare minimum, oftentimes what we look at when we see a situation like this is we tell individuals, if you want to invest directly in real estate, then you should set up a limited liability company held by your IRA to actually hold the risk asset. And that provides you a liability shield should anything go wrong. So there's a lot of things going on in this one.
No, yeah, all really good points. And, I think probably the best answer to this is before you make a transaction, check with your legal advice, your legal team first, and make sure that, hey, I'm doing this, and if that your little radar goes up and off and it says, I think this might be a prohibited transaction, that's the time to get somebody on the phone that knows what they're talking about it. So all good points. So I think we kind of talked about this a little bit. But Clint, can you kind of walk us through what you cannot do in the IRA?
Yeah, so with what we're showing here is we talk about the disqualified parties, the IRA owner, your spouse, your entity that you own 50% of, but you couldn't engage in a transaction with your IRA and any of these individuals. Mistakes that you see people run into, they use personal funds to pay for expenses related to the IRA investments. Let's say that your IRA is running a little short on cash. You don't have enough money to cover your property insurance. Then you decide to pay for that personally. That would be a problem. There are limited exceptions to that, though, with regards to property taxes. You can actually, in certain circumstances, pay for plan expenses. But for the most part, you need to avoid doing something like that because that's considered to be an impermissible investment and can blow your plan up. I talked about the providing services to enhance the asset's value. So you'll see this with a lot of investors who invest directly with their IRA. They're real estate investors themselves, and so they're used to doing things around the property. And really, when you're investing with an IRA, you got to take a more hands-off approach. I had one client. He's in North Carolina, and he has one self-directed Roth IRA with 60-some properties in it. And I was talking to him. He was at an event, and we were discussing his IRA, and he told me that, about 28% of my clients pay me in cash. So you're not talking about your IRA? He goes, yeah, my IRA. I collect the cash. And then I said, what do you do with it? He said, well, I take it down, I hand it to my custodian. I mean, that right there, if it was ever audited, is a prohibited transaction because you cannot be touching the funds directly at all. Everything has to run through your custodian. If you don't have an LLC set up where you're the manager and the LLC is owned by your IRA, if the assets are held directly by the IRA, then it's all has to run through the custodian. You have to take a hands-off approach. And for a lot of real estate investors, they're not accustomed to taking that fully hands-off approach, and they can create problems for themselves. And then you'll see people, thinking they can borrow from their self-directed IRA. You can, as long as you repay it within 60 days. And if you don't, then that's considered to be a taxable distribution to you. And depending on your age, you could be hit with that 10% early withdrawal tax. So there's little nuances here that you need to be up on if you're going to be making direct investments with IRAs.
That's great. So let's talk about the next case study. So Corey, let's say, has $100K in his SDIRA and would like to purchase a rental house for $200,000 in Tacoma, Washington. Corey has $100,000 in his personal savings account to fund the difference, but only $100,000 in his IRA. Can he combine the two dollar amounts and buy the house? Well, of course,
yes.
Yeah.
And that, Ryan, that goes right to that point I was talking about. When people look at something like this and think, all right, well, isn't this a disqualifying transaction? Yeah, you can go to the next slide. And the answer is it could be, depending on how you structure it. So this is where you need to set it up right because it's a one-shot deal. So let's say that I want to buy a house or I want to invest in a syndication. And the minimum investment level is $100,000. And I have $50,000 in a retirement account. I have $50,000 in cash. Well, how do I come together to put that investment together if I have to come in just as one investment for $100K? Because the syndicator isn't going to say, all right, we're going to have two investors here at $50K. They only want one investor at $100K because That's the way the syndication was set up. That's what their PPM states and the operating agreement. So what we'll do in those situations is we'll create a limited liability company, and we would have the LLC owned by the individual investor and by their IRA, and it would have to be proportional to the investment. So in this example that we put up here, and the example that I just gave, it's a 50-50, right? Corey was coming in with $100K from his IRA and $100K from his personal account, or the one I talked about, the syndication. It's $50K from the IRA, $50K from the personal account. So what we would do is we'd set up the LLC where Corey is the manager, and he is a individual 50% member, and his IRA is an individual 50% member. So now you have the combined funds to make the investment. Now, at that point in time, any further transactions between Corey and the LLC or his IRA and the LLC, for example, if he wanted to do another buy or put more investments in, and say he rolled money out of a 401k plan with a prior employer into his IRA, brought in another $100,000 and wanted to put that into the LLC to make another investment, you can't do it. That would be considered a prohibited transaction, because right now that LLC has become a disqualified party. And so this type of partnering, I always call it a one-shot deal. I mean, it works at its inception, but once the LLC is funded, it's locked down. And so there cannot be any more contributions to the company. Now, on the flip side, pulling money out, that's simple. You can always pull money out. But here's where investors tend to want to get greedy and push the envelope. They want to set up a structure like this, for instance, where they're putting in $50,000 from the individual and $50,000 from their IRA, and rather than make it a 50-50 split, whereas meaning that if the LLC, the return the LLC received this year was $50,000, that would be split $25,000 taxable to the IRA or attributed to the IRA, which may not be taxable, and $25,000 would be attributed to Corey, which of course would be taxable to him. I've seen creative investors tell me that what they're going to do is they're going to make that type of contribution, but give their IRA 99 or 95% ownership. So 95% of the income the LLC receives will go to the IRA or be attributed to the IRA and won't be taxable. That will not be respected because it lacks economic substance, and if it was picked up, it would be challenged, and it could for surely get caught, because that LLC is going to file a tax return and give a K1 to the IRA and a K1 to the individual. So your investment has to be proportional based upon your contributions. So if you did a 50-50 in my example, if you made $50,000 that first year, then you would just split it amongst the individuals to be taxed down to the IRA owners. Whether or not you distribute, it's up to you. You're the manager. But if you do pull the money out and make a distribution to the partners, you cannot put anything back in again, as I stated. So LLCs are great for doing this type of deal. They give you a lot of flexibility, and sometimes it will allow you to accomplish investments or put investments together that ordinarily you couldn't do on your own or with the IRA itself. And that's one of the things I teach at my events. I tell people that, entities can help you find or put deals together, that they can help you grow your real estate investing business. Because if you know how to structure things, if you have the right tools in place, you're going to be able to do more, and you're going to be able to do them faster than the other investor that you're competing with for that investment. Because as they're struggling trying to figure out how they're getting the money, you have the money. You just need to know how to access it. And if you have the right entity and the right team in place, you can get access to those funds, and you can move much quicker. And of course, you're probably going to be able to close on the deal where the other guy could not. So you can partner with your plan.
Yeah, great strategy for those investors that are thinking, I want to do a deal, but I've got money over here, money over there, and you want to combine it together. So great points. Thank you for that. So the next one, this is the one that when we get into UBTI and UDFI, this is the one I really want to stress to our investors. When you do use a self-directed IRA or solo 401k to invest, that you may be, and probably the chances are, creating a taxable event probably 100% of the time. So let's talk about UBTI and Clint, I know you're familiar with the types of transactions that we do, buying self-storages and operating them and then selling them for a profit and then also building them from ground up, and maybe how that might apply to somebody's investment if they use a self-directed account.
Yeah, so in the issues that you run into, and I gave the example here of a syndication. So in this particular case, I was working with a syndicator who was flipping properties. They were developing this land and building new homes and then selling them. And when they approached me, they told me that they had a lot of investors brought in IRA assets, and they wanted to do a risk analysis of their overall plan to see if there were any potential issues there they needed to share with their investors. And the first thing I brought up that I saw here was the fact that the nature of the activity was going to create taxable income to the IRA, because the flipping of properties in this particular project, that would be considered to be an active trader business. And a retirement plan that engages in an active trader business, it doesn't disqualify the plan. What it does is it creates taxable income. So if you're flipping homes and you have an IRA and you generated $100,000 from the flipping of properties, then of that $100,000, 37% or $37,000 you'll have to pay in federal income taxes, because it's going to be taxed at a flat 37%. The IRA trust tax rates are very compressed. Once you get about $14,000 in income, business income, taxable income, then you're at a flat 37% from then on up. So many investors aren't aware of this, and will it get caught? Potentially, but it's something that you have to factor in, because the IRS is going to expect you as the IRA owner to report it on Form 990T, and then your IRA would have to pay that tax. So when you're making an investment into an LLC or a syndication, knowing the underlying business activity of that syndication is really important, so then you can factor in what your actual return's going to be on that investment. So when you talk about self-storage, the leasing of property, running the self-storage business, and then the subsequent sale, would that amount to unrelated business taxable income? Well, that one is really close to the line. I would say that's in the gray area. You could make the argument that it's not an active business, that you're a passive investor, and that you're just leasing property to individuals, and that most of those leases are for a period of a year, and that it is capital gains income, or it's not income from the active trade of the business itself. Whereas, and then of course the subsequent sale would not be, that would just be capital gains. So you could argue that would not result in that. One of the things you may look at in the syndication, if somebody was engaging in that, is to make it an even cleaner delineation, is maybe you have an operating corporation. Depending on how these structures are set up, you have an operating corporation that does the actual leasing, and the syndication itself is involved in a master lease arrangement. So there's ways you could even give further protection to investors as well. But it's something you need to be aware of. I don't see it as so much of a problem on the self-storage side as you would on the example I gave with the house flipping, but it's out there, and it depends many times who's in charge of Congress or the Senate. When the Senate was in control on the other side of the street with the Democrats, this was a serious issue for IRA investors. What I've seen now, since there's been a change in the Senate, a lot of that has tempered down. Audit rates are down as well. And so you have not seen this aggressive posture by Treasury against people who make these types of investments as it used to be. Because for a time there, I used to blog about this. And actually, after about 2 years of blogging about it, I finally quit doing it, because it was just like the same thing over and over again. The IRS was nailing people, but you've seen that kind of temper off. So it's just, you need to know it, and you should have it evaluated.
Yeah, great point. And this goes back to getting a little strategy before you make a decision to invest with cash or your IRA or a solo 401k. There may be consequences. So the next example I want to talk about is something called UDFI and how that could be tripped. So same thing, Corey has 500,000 in an IRA that he would like to invest in a syndication, and 70% of the deal is leveraged, and he gets a 20% interest in exchange for his investment. So, and just to clarify, about 70% of our projects at Spartan are leveraged. So this is a very applicable example case study. And, we leverage anywhere between, 60 to 85% of the project. So, definitely that might be something that you have to be aware of. Anyway, Corey receives a preferred rate of return of $50,000, so 10% cash on cash for the 5 years. Then a lump sum of $1 million when the property is sold. So using his IRA, here are some of the, I guess this came through as a one by one. There you go. So using his debt financing, he gets UDFI. So Clint, let's talk about how he gets taxed on that, on the leverage.
Yeah, so this is the hidden, the Trojan horse for many IRA investors that invest in syndications. They're not aware of this. The syndicators are not giving them the information like you are and telling their investors, hey, you got to be aware of the fact that we're using leverage and this can create a taxable event for your IRA. You see, when you're using leverage, it falls under unrelated debt financed income. And the way the income is then calculated to determine whether or not it's taxable, you look at the overall investment itself, the project, the syndication you're investing into, and you figure out what is their leveraged amount. In my example, it was 70%. Once you know what that leveraged amount is, then you just take and you multiply that number times whatever income you generate that year from your investment in the syndication. So if it's 70% and you bring in $50,000 that year on your 10% preferred return, well then $35,000 of that $50,000 your IRA received, or even if you don't receive it, that's attributed to it, is going to be taxable. And so what I put down on here is I said essentially your IRA is only going to collect $36,000 of that $50,000 because you're going to have to pay the IRS the difference, the $13,900, $950 essentially in taxes. And so your return then, if you're calculating it out, it's not the 10% you thought you were getting, it's actually 7.2%, because factoring taxes in, my IRA only got a 7.2% return. And then when the money is taken out, you got to remember, since it's in an IRA, that money's going to get hit again. So you don't get a credit for any taxes you paid. And so when you take it out, again, assuming you're getting taxed at 37%, the amount of money you're actually going to receive on that $50,000 on an annual basis is $22,000 when it hits your individual pocket after taxes. So your return is really closer to 4.4% in the example I used. And so that's just on the annual income. What it doesn't take into account as well as what you have to factor in is when you sell the property, when the syndication later liquidates that, property stabilized, we've got a 5-year window, we sell it in year 5 or year 3, whatever the plan was, then 70% of what you bring in, or in this case, he's supposed to get paid out $1 million at that point in time. So 70% of his gain would be taxable as well on that sale. And so this is the stealth tax, like I said, the Trojan horse that is just floating around out there, and many IRA investors are not aware of it. If they're not investing through syndications, I've seen people do it with real estate themselves. They buy a direct investment that's leveraged, non-recourse, and they have no concept of the tax ramifications of dealing with it. So unrelated debt financed income is I think a serious problem. And if Treasury wanted to focus on something, this would be where I could see them placing their focus. Again, the way they're going to find out about it is through that 5498, because that's going to get reported that your IRA is invested in this type of asset. And anyone that is familiar with syndications, they know they're always leveraged. I mean, that's what makes them work, right? So if you wanted to take a look at the underlying assets, I would audit those IRAs, and that's where I'd be able to pick up extra tax revenue through these types of investors.
Great point. And some of our deals actually are not leveraged. So if you're a SDIRA investor and you're thinking about, using, again, the strategy of using cash versus using your IRA, you might want to look at how the property is leveraged to factor into your decision making. So, oh shoot, so there was your tax liability on the sale example. Sorry, I didn't switch the slide. So, but we talked about that quite a bit. So, we're going to go into some of the drawbacks of the SDIRA. These are just some of the things that that might make you either set up a different account or not do the IRA. So I think we talked about this a bit, but Clint, why don't you take us through some of the reasons why maybe there might be some drawbacks in the IRA?
Yeah, so the main drawbacks that I see with the IRA is, number one, you can't sign on behalf of your plan. You got to run it through a custodian who's going to sign on your behalf, again, because you're not allowed to do that. So that can be an issue. IRAs have the taxes that we discussed, and the fact that if you make a mistake, there's no do-overs. So those are concerns that I have, in addition to the scrutiny that they've received in the past and may receive in the future. So when I'm considering my options, if there's a better tool out there, I'm going to look for a better tool, because I just don't want to have this cloud floating over my head. The thing that I always look for in structuring our clients is we want to create maximum flexibility, so that they can be nimble, they can move, their investments around without there being too many constraints. Because as you become less flexible, it makes it harder to put deals together. So these are a good representation of what we have on the slide of the drawbacks, and many people haven't heard of them before, because the IRA industry is just huge right now. There's so many people out there promoting it. They don't want to talk about the negative aspect. They just want to talk about all the positive. That is, you can control your investments, which is true to an extent, right? Because that custodian still has to be in play, or that third-party administrator making the moves for you. You just have to direct them. So you got to be aware of it.
No, that's a good point. And the other thing is, you have the control, but really, I mean, that's if you're operating the business or operating the deal yourself. You control. I mean, obviously, if you're investing in a syndication, you're taking control of the decision, but a lot of that control is given up to the operator. So let's talk about avoiding UDFI. We've encouraged investors to consider using a solo 401k, to avoid UDFI, but not all investors may qualify for the solo 401k, because you typically have to have self-employment income. But we've also kind of highlighted projects that Spartan has that are all cash. A recently funded, closed, and wrapped up project, the Landing on Lamont. That was a project where we used no leverage. We just did all cash. So, my understanding is that would have avoided having to pay any UDFI. Is that correct?
That's correct. Yep.
Yeah, and it's you mentioned that it's extremely rare to have an all cash deal, but if we do have an all cash deal in the future at some point, that might be a good thing for using your SDIRA. It just gets rid of at least one of the potential tax drawbacks of UDFI. And then my understanding, Clint, investing in private loans or lending wouldn't subject you to that either. Is that correct?
That's correct. You wouldn't be hit with UDFI on any investments you make. As far as if you're buying debt, no, there's no UDFI there. It's only when you borrow.
Correct. So yeah, we've done a couple of deals where we do private lending, where we set up a deed of trust and a promissory note. On one of our projects, we did that. There wouldn't be any UDFI. So if you have an opportunity to do that, that might be a good way to not pay those taxes.
Yeah. So the way I look at this is, if you have a Roth, then your only option is to go the IRA route, and so that's going to have to be in a self-directed IRA to make these investments. But if you've got a traditional IRA, I would strongly encourage you either to set up a solo 401k or a 401a plan that we would set up, and you roll your existing IRA into that new account. And the nice thing about it is you can actually pool accounts. So if your spouse had an IRA, she could roll her IRA in to that solo 401k, and together then you could invest through that one account. So the syndication issue where you have the minimum investment, you could meet that threshold through your plan by pooling your accounts together inside of a solo 401k. And then once you do that, not only do you get out of the UDFI issue, because UDFI does not apply to solo 401ks, you're then going to open up other additional opportunities for you that do not apply to IRAs. So we talked a little bit about one and done, right? You make one mistake and it burns your IRA. Well, when you have a qualified retirement plan like a solo 401k, you can make a mistake and it's not going to burn your plan. You're going to pay a small penalty tax on the portion of your plan that engaged in the mistake, but that's it. Everything stays in your plan and nothing falls apart on you. You can even borrow from this plan personally. So if you needed $50,000 and you had a $100,000 plan balance, you could borrow out $50K. But more importantly, you're the trustee of your own plan. So unlike dealing with a custodian where they're going to have to sign off on the paperwork, you sign off on everything, because as the trustee, that's your responsibility. So you have a tremendous amount of control, and which then provides flexibility, which then allows for you to put deals together quicker, because you're taking care of the entire transaction. Now, a lot of times they're referred to as, you get a checkbook essentially on your account. So if somebody wanted money, you could write them a check, or you can wire them funds directly out of the account, and it really puts you in the driver's position. So if you want to avoid it, I would go the more flexible tool that gives you greater benefits. And there's no reporting to the IRS under 5498. I've been doing it, for 20 years, creating these plans. They don't get audited. In fact, if your plan's not above $250,000, you don't even have to file a tax return on the plan. So there is nothing that goes anywhere that anyone's going to be looking at. So I think it's the preferred route to go for anybody that has these types of assets and looking to make the investments we've been talking about.
And I've heard conflicting information on the solo 401k. My understanding is you can set one up and not be self-employed, but you cannot contribute to it if you're not earning 1099 or self-employment income. Is that right?
Well, that's not how I would do it. Typically, what we're going to do is look at the individual investor and find where's there an opportunity to create a business, an LLC or a corporation to sponsor it. And then depending on what their desires are, if they want to make contributions, we'll go with a 401k. If they don't want to make contributions, I'm going to set up a 401a, which is referred to as a profit sharing plan. So there isn't that expectation at some point in time that there would be a contribution coming from the employee, because most employees, again, are going to contribute to 401k plans. So we use those plans depending upon the client's objectives in making the investments. But the sole proprietor route, you have to have an actual business to set up a solo 401k. So I don't like to use solo 401ks off sole proprietors, because that implies Schedule C income then. And I want to keep it more in the business context. So if you had rental real estate, I could create a plan around that for you. Any other type of business activity that you would engage in, maybe private lending, we could create it. Airbnb, we could create the business to sponsor the plan without there being any red flags thrown up. The example you gave, I think it's a great example, because that, I think, would create a few more red flags, because it all comes down to what is the sponsoring entity, what is the sponsoring business to set up the solo 401k, because there's that presumption.
Right, that makes a lot of sense. And the 401a option, I've never heard of that, so I'm glad we talked about that. That's a great strategy. So, setting up a solo 401k, I think we talked about this a lot, but generally for the self-employed income earners only, avoids the UDFI. We've talked about that. Higher yearly contribution limits. So that's kind of a nice benefit versus an IRA, and works similar to an SDIRA with, obviously, I think we covered the caveats, which the differences here. So how can we learn more about this? If somebody, says, wow, we covered a lot, Clint, I want to learn more about how to set this structure up. What do you guys offer at your firm?
So what we like to do is we like people to come to one of our events. We teach a 3-day tax and asset protection workshop for real estate investors, where we walk you through various business entities, the creation of self-directed IRAs, solo 401ks, 401as, how to use them in your investing. And more important, we also talk about taxation, how to reduce taxes through your investing, how to set up your investing so you look better, as we talked about earlier, look better to lenders, to grow your business. And so it's designed around that three-legged stool concept. And then we discuss, how to pass it on. So if you want to learn more about corporations, LLCs, land trusts, living trust, 401ks, IRAs, real estate taxation, cost segregation, things like that, this event has been designed with that in mind, and it's taught by myself and my partners, so real estate investing attorneys that are actually teaching it. So we're not teaching you fluff or giving you theory, which you find in a lot of these types of events where, it's not like you, Ryan, where you're actually out there doing these deals, and so you're talking from experience and putting deals together. That's the way we speak. I mean, there's things that people tell you, oh, you could do this. Well, if you're an active investor, you know what you can do and what you can't do based upon what title requires now, what lenders are requiring now. And so our approach has always been, let's show people how to actually go out and grow a business around their investing and make it successful, because they're not approaching a lender with a Nevada corporation trying to get a non-recourse loan where their name's not associated with the entity. I mean, that's just a recipe for disaster. It's going to unravel on you, and you're going to, be out of the game before it's even started. So it's very comprehensive. More importantly, what we do with everyone that attends is we sit down with them and we help them design out their own plan of attack blueprint. So what I feel is important is that we're teaching you strategies, we're showing you the theory, but then it's the application to you as an individual. So we make sure at each of our events, if people want to sit down with us, we'll sit down with you. That's part of the event. There's no additional fee for that, and actually design out a plan and show you how it all comes together. And anybody's listening that would like to attend one of our events, we teach them all around the country. You can go to andersonadvisors.com/bulletproof. It's $197 for the 3-day course, and there's some other benefits you'll see when you go to the page of what you'll receive if you want to sign up. And then it's just a matter of picking a time and a date that works well for you. We typically have 2 events going on every month in different locations. We hold a lot in Las Vegas because that's where one of our offices is located. And so, I'd like to see you guys out there. And if you're serious about real estate investing, you want to take it to the next level, we can help you do that.
Awesome. Yeah, and I can relate to the my Wyoming LLC that has a Pennsylvania LLC that has a property and an LLC in Philadelphia. That getting that loan and living in Seattle was very difficult, and I got sold a protection plan that just did not work and was not practical for what I wanted to do. So yep. I definitely hear you on that. So we've got a little bit of time for Q&A. Clint's contact information is on the screen as well as mine, if you wanted to follow up with questions. But we do have a couple questions from the viewers. One question is, you said everything has to go through a custodian of the SDIRA, but what happens if we have checkbook control of our SDIRA? I'm wondering about the distributions I'm receiving from investments. Do the distributions need to be made to the custodian rather than distributed directly to the bank account being used by the SDIRA that has checkbook control?
So in a checkbook control IRA, that implies that there's an LLC set up, because that's the only way you could structure that, is to have a limited liability company that's owned 100% by your IRA. If that's the structure you're running it, then yes, the investments would come to the LLC's checking account. If it's going to your personal account, then that would be a problem. Or if you open up an account under an IRA, I don't know how they would even set this up, where you're the signer on the account, that would be a prohibited transaction because you wouldn't have that ability to engage in those types of activities. It has to be indirectly, not directly.
Okay. And the other question that we have is, what is the maximum ownership I can have in a deal without it being a prohibited transaction?
Oh, there is no maximum ownership you can have in a deal without there being a prohibited transaction. It's just the number of factors we would look at is, who are the other parties involved and how is it being structured. But if I wanted to go out and buy 90% of a syndication, I could do that. That wouldn't be an issue for me.
Gotcha. Okay, that's a great couple questions. Are there any other questions from the group? There's a little question chat area that you can ask the question in, and then it just pops up. Where do I go to find out about more? Where do I go to find out more about Clint's services? I guess that would be andersonadvisors.com. Is that right?
That's correct.
Awesome. Any other questions from the group? See if I have any in here.
Yeah. Well, it's just one of those things, the IRAs investing, it's a small part of what real estate investors or tools that they have available to them. And if you have, other real estate assets, you should be looking at how to protect them. So if anything were to go wrong, that one mistake won't cost you everything you've been working hard to build up. Because, being in this business for as long as I've heard so many stories from people who, just one tragic mistake and it wiped them. And, it's no fun starting over at age 62 to build up another 30 properties. I've heard people say, "Oh, it's easier a second time around." No, anybody that tells me that, I have a feeling they never made it the first time around, and they're just some cliche they're attaching itself to. Because I can tell you, to get to where I'm at with my own real estate investing, having over 100 properties, it's taken a lot of work, and I would never want to go through that again to get to this point. So sound protection, I think, is really, really important.
Okay, another question we had, how long does it take to set up an IRA? I'm interested in using one to invest in a deal sponsored by Spartan. Clint, do you guys actually, along this question, are you guys a custodian, or do you guys set these up for people?
No, we do not set up IRAs. We're not a custodian. We're not a third-party administrator. We just would refer that out.
Gotcha.
Yeah, we just set up solo 401ks and 401a plans.
And how would you how long do they usually take to set up?
So to set up a solo 401k plan, to get all your monies rolled into it, it's probably going to take you about 2 weeks. Not to create the plan itself, it's the roll of the funds. The way I use Charles Schwab. So we create the 401k plan, and while we're setting it up, we direct the client to open up a rollover IRA with Schwab. So Schwab will collect their funds from their current IRA custodian. And so that takes a few days to get those funds rolled into Schwab. And then we have them open up their 401k account under our plan, which is key. Open up an account with Charles Schwab that gives them check writing privileges. So then once that account's open, they just tell Schwab, "Hey, I have an IRA here. I need my funds deposited into my 401k account." And so they roll the funds right over. It's instantaneous. And then now they have the funds in their 401k that they can then direct out. So that it can take up to 2 weeks, because where the slowdown comes in is the IRA rollover, getting the funds from the existing traditional custodian.
Gotcha. And another question I have from the group, how much does it cost to set up a 401k, and do you do all of the reporting?
Yes. So the way we set up the 401k plans, it's $3,000 to set up the 401k, and then we if you need to take a loan, we provide that. And then if you want us to provide the tax return, then there's an additional fee for us to do the tax return. But we do create the plan and provide the administrative services for the first year on that plan.
Gotcha. And just maybe a personal question for me, but as a sponsor, can I use my solo 401k to invest in Spartan sponsored deals? And I'm asking this.
Absolutely.
Oh, really? So even though I control the business, I can invest with using my solo 401k? That's interesting.
Well, you're going to be able to invest because even though you control the business, it's no different than, remember we talked about when you set up your LLC, you're investing in with everybody else. It's not an existing business that you own that you're investing into. So long as it happens at the same time. Oh, wait a minute. Because you're pulling, well, listen, we don't want to talk about this one on air because I'd have to know more about how you're pulling the money out on the side. If you're pulling money out on the side through a promote or something like that, that's going to
that
disqualify it. Yeah,
no, we're always just looking for that because we're we're trying to invest in our own projects.
Yeah.
But anyway, we're right at the hour, so Clint, we really appreciate you coming on here and dropping your knowledge and sharing your wisdom and your experience with real estate investing. Any final questions here from the group? I don't see anything. But we appreciate you coming on, and this webinar will be recorded, or was recorded, and will be sent out. So thank you, everybody, for being on, and we'll talk to you on the next one.
Right on. Thanks for having me on, Ron.
All right. Thanks, Glenn. Have a good day.
Okay, bye.
Bye-bye.